Hi, everyone. Welcome to Freeman Spogli Institute and the Food Security and Environment Program's fourth session on global food policy and food security. Recognize a lot of faces at this point, and so I'm glad that some of you are following because, in fact, it is a curriculum that we're delivering here for a 12-part series, and it's great to have many of you in attendance each time. As I said, this is our fourth series, and this one is going to be on managing food price volatility, approaches from the global, national, and household levels. I'm Roz Naylor. I direct the program on food security and the environment, and with Wally Falcon, who also co-directs the program, we've been excited to present this whole series. I've mentioned it to you before. This is a series that's directed to you as our audience, but also to audiences around the world. It's our first distance learning curriculum that's really directed towards masters and future policy and analysis programs throughout the world, sub-Saharan Africa, South Asia, and throughout the United States and other parts of the world. And so you will all be participating in a global program. Ask good questions is what I'm saying to you here. Anyway, this is a really fun day today because we're focusing on food price volatility, and those of you who are tracking this issue know that prices of commodities, particularly maize, wheat, and other food commodities, have been incredibly volatile this spring, bouncing all over the place. And so we are in a period of high price volatility now, and the question is, should the international community be trying to stabilize prices? Should national governments be trying to stabilize prices? And what are the impacts really on poor consumers, producers, traders, and so forth? And so we have two excellent people to deal with these issues today. The first is our main speaker, Peter Timmer, and those of you who have come to an earlier session know him from commenting on the structural transformation lecture. Peter comes from Harvard, both as his undergraduate and PhD in economics, and he has a very long and very esteemed history in a number of institutions. He was a tenured faculty member here at Stanford in the Food Research Institute, also a Babcock Chair at Cornell, a Cabot Chair in Development Studies at Harvard, the Dean of the School of the Pacific Studies at UC San Diego, Senior Fellow at the Center for Global Development. And you can see this list goes on so long, I actually have to look at my notes on this part because he's always under very high demand. He has been a visiting professor here at the Food Security and Environment Program and actually was instrumental in helping us get this whole symposium series started. So, Peter, we thank you for that. Peter has a long history. I can't go into all the books and papers that he's written, but he has a long history of an extensive publication record. Two of his most notable books are Food Policy Analysis and Getting Prices Right. And those books, I think, particularly Getting Prices Right, we're going to be talking about prices and where to set prices and should we be stabilizing them today. So a lot of the lessons that Peter has been teaching all of us over many years will come out, I think, today. Peter has an Asian focus. He's been a very long-term advisor in Indonesia and a half a dozen other countries. He's really an international policy advisor to a large extent, advising, for example, the G20 as they're moving into their recommendations right now to stabilize food prices and commodity prices in international markets. That's going to be coming up soon. He'll talk a little bit about that. In a broader sense, Peter's a big contributor in economic history, food policy analysis, and agricultural economic development. Pro-poor growth, technological efficiency, structural transformation, these are all issues that he works extensively in, and particularly in the area of price stabilization. So Peter, we welcome you today. I should note that Peter is quote-unquote retired, but if you look at his flight record, he is actually the one factoid I need to share with you. Peter knows every flight number and carrier to every major city in the world, and so you can quiz him on that over a glass of wine. I want to quickly introduce our commentator, which is Jayne, who's coming to us from Michigan State University. He's a professor of international development in the Department of Agriculture, Food, and Resource Economics. He's also been a core faculty member in the African Studies Center at MSU and has a longer history at MSU, although he did his undergraduate degree in Bucknell. He did both his master's and PhD at MSU in agricultural economics and has continued a very long history of strong agricultural economics and policy analysis that MSU is well known for. In fact, we're trying to recruit a number of his students now, one of them sitting in the audience, so I hope you impress her. Thom has worked in a number of areas, particularly focused on Africa, and the areas are poverty reduction strategies for Africa, food marketing, trade policies, farm productivity, and even in the area of HIV/AIDS and agriculture. So he has a wide and varied background there too. He has an unlimited number of papers as well, so I can't go into them, but he has won a number of prizes for the quality of these papers, so he's well worth following in the literature. He is now directing the food security research project in Zambia. This is a larger project that's been focused on parts of Africa, and this one is particularly in Zambia. He and his wife are living in Zambia. So he's coming to you from Zambia. He may look a little jet lagged, but we've loaded him up with caffeine for the afternoon, so he should be okay. But he's also involved in other Gates-funded activities, for example, guiding investments in sustainable agricultural markets and African agricultural market programs. And so he's working with a core group of countries and universities and other institutions throughout Africa. He's really well known in the Africa area. So I think what we have today is a really exciting program that will enable you to really understand the principles of food price stabilization. What should we actually be doing in this crazy market to the benefit of consumers, producers, particularly the bottom billion who are barely able to get a sustainable diet and feed their families. But we're also going to be able to juxtapose some perspectives from Asia with Peter and from Africa with Thom, and I think that really provides a number of instructive lessons that go back to the theory. So I welcome you both, and we'll start with Peter. Thank you.
Cool. Thanks, Alice. Okay. Thank you all for coming. Yes, familiar faces. This is turning into a regular classroom. I mean, we're getting a regular group, and I think that's a wonderful thing for the series. But it's nice to have some continuity in the group as well, because at least for those of us who've been here for each of the sessions, we can hark back to some of the earlier comments. In fact, let me start with a pop quiz. Our previous speaker was Chris Barrett, and he spoke on, got to get the title exactly right, Assisting the Escape from Persistent Ultra-Poverty in Rural Africa. And his key entry points for assisting the ultra-poor were, first, build and protect the ultra-poor's productive assets. Second, improve the ultra-poor's asset productivity. Third, improve risk management options for the ultra-poor by A, risk reduction. By that he included improved crops and livestock, better water control, diversification, peace, and disease control. And B, risk transfer. So you reduce the risk or you transfer the risk of the poor. And under risk transfer, he wanted to improve markets, use index-based risk finance, and when all else failed, a global humanitarian response. Okay, most of you will remember that. Now, the question, what's missing from that list? Any use of stabilization instruments to reduce the risks from volatile prices. That's not something Chris had in his list. Why not? Well, I mean, he may not think that risk is important, but in fact, most economists think that stabilizing food prices is neither desirable or feasible. It's an awfully nice world if, because it's not feasible, you can decide it's not desirable. But most economists start with it's not desirable, and then, by the way, you can't do it anyway. Today, I want to argue to the contrary. I actually believe there is a right price. I'm going to show you a series of quotes that Joe Swinnon and Scott Rozelle have put together. But Roz mentioned getting prices right. And I'm going to read you the first paragraph of that book. It was published a quarter of a century ago. 1986, 25 years ago, is when Getting Prices Right was published. And the very first paragraph, it's short, don't worry. What is the right price for an agricultural commodity? Economists have an easy answer to the question, but only in a world of perfect information, with competitive markets, without other government interventions into the economy, and without political concerns for the impact on income distribution. In such a world, any deviation of the domestic price from the international border price of a commodity as either an import or export reduces total economic welfare in the country because of deadweight efficiency losses in production and consumption. In fact, for those of you who really think about the world through the border price paradigm as economists, in a world where the border price paradigm holds, price instability adds to consumer and producer welfare. The more unstable the price, the greater the consumer surplus and producer surplus that's generated over a series of years. And anybody who can bring me a piece of paper at the end of this with a simple geometric proof gets an extra glass of wine at the reception. So, what do the key organizations think is the right price of food? Oxfam, in 2005, thinks 900 million people are losing their livelihoods because food prices are too low. In 2008, 967 million people are malnourished because food prices are too high. I actually got a call in early 2008 from colleagues I'd been working with at Oxfam, the ones based in Washington, and it was gee, Professor Timmer, shouldn't we actually be happy that food prices are high because we've been complaining that they were low? IFPRI, the International Food Policy Research Institute, in 2003 says agricultural protection and subsidies in the rich countries causing low prices in world markets, increasing poverty, and weakening food security. In 2008, rising food prices threaten the food security and further impoverishment of the world's poorest people. FAO, UN Food and Agricultural Organization, in 2005, the downward trend in commodity prices threatens food security of hundreds of millions, and in 2008, rising food prices worsen an already unacceptable level, and we've got 854, not 855, we've got 854 million people who are suffering because food prices are too high. The OECD, the IMF, the World Bank, in their joint analysis in 2003-04, condemn the export subsidies from the rich countries that drive down world prices. The majority of the world's poorest households are agricultural, and so that's got to be, it's especially alarming, is the term they use. In 2008-09, the increase in food prices represents a major crisis for the world's poor 105 million people. So, one conclusion you might come to from those 4 slides, apart from the old lesson that Wally Falcon and I put in food policy analysis about there is a food price dilemma. Farmers like high prices and consumers like low prices. And so there's always going to be some controversy over whether you've got a good price. But what do you make of the major NGOs, research think tanks, and the donor community trying to figure out whether prices are too high or too low? One conclusion is, well, they don't know what they're talking about. And so whatever the price is, at any given time, it's wrong. There's something wrong with the price no matter what it is. I would like to argue, on the contrary, that prices can be too high and prices can be too low. that something in between too high and too low might be the right price. And then the question is, how do we figure out what that right price is? And what my particular topic is today is, how do we keep it reasonably stable around that right price? Let me note that the talk today is not about the causes of food price instability. That's a talk I could give, but it's a much more technical talk. It would be a way more controversial talk, and this one's going to be controversial enough. We need to understand causes if we're going to intervene successfully to change prices, but I'm really more interested in the impact of volatile prices, of unstable prices, as a way of motivating efforts to do something about them. Okay? And to do that, we've got a framework. I owe not just this photo, but the entire artwork for the PowerPoint screen to my daughter, Anne, who's a professional designer. This is a historic occasion. This is the very first PowerPoint presentation I have ever done. And Wally said I had to have a PowerPoint. So bear with me as we work our way through this. I figured out what it was I wanted to say and sent it off to Anne, and she sent back a really nice set of slides. She took this picture in Thailand herself. Anyway, here's the framework I want to use for talking about, if you like, the motivation, but putting the context, putting food security in a bigger, a macro context and a long-run context. This divides the world very simply into short run and long run. Short run is where politicians are working on problems that are right in front of them. Macro and micro. Macro is the level at which policymakers are operating. They're worrying about budgets and exchange rates and instability and crises. And micro is where households are and firms are and the traders. This is the sort of the decision-making units that make an economy work. We start the analysis in the upper left corner. That is where we are dealing with the short-run reality, the crisis that we have on our hands at the macro policy level. We're managing these crises. We're budgeting. We have to figure out where to get the money for the safety nets that we know we're going to need to help the poor. And that's where we are as a starting point. But where we want to be is in the lower right-hand quadrant, where we're in the long run at the micro level, where all of those households now have access to productive work, whether it's as farmers or as wage workers or as entrepreneurs or whatever. They have access to nutritious food on a reliable and sustainable basis, and that's my definition. If you've got a good income and access to nutritious food, that's my definition of sustainable food security. So the goal is to get from the upper left to the lower right. And a lot of us would love to be able to just go there directly. Just follow that diagonal arrow down. And I've got that arrow pointing in two directions. It's got it's got an arrow at each end. And the reason I draw it that way is that if the macro policy folks could somehow create that environment for poor households, that they raise their productivity and they have sustainable access to food, that would generate a lot of political support that goes back up to the macro environment. So there's real incentive to try to do that. And the problem is that market economies don't work that way. Market economies require that at the macro level, we actually put in place a set of investments and policies that will sustain economic growth that is accessible to the poor. The common term is pro-poor growth or inclusive growth or whatever you want. But it is economic growth that pulls people out of poverty into productive and sustainable jobs and allows them to have the necessary material well-being in the context then of the food markets that will go with that. So that creates the conditions by which the poor can get out of poverty. On the short run side, we have to worry as we go from macro to micro, we have to worry about what Chris Barrett spent much of his talk on last time. That is, how do we keep what he was calling the ultra poor, how do we keep them from basically perishing? How do we keep them from getting into a poverty trap, having to sell their assets, and basically spiral downward in their nutritional well-being, and their kids die from disease or even, in some cases, starvation? But so how do we get the necessary resources to the poor to enable the poor themselves then to participate in the growth process, and that is for the poor to move themselves to the right? So we need to move macro into the long run. We have to be sure that in the short run, the poor have the capabilities, to use Amartya Sen's term, have the capabilities in health, in nutrition, in access to technology, other assets. The poor have to have enough capacity to do the investments themselves. I don't know of any successful poverty reduction programs that were done through government subsidies to the poor to get them out of poverty. All of the successful poverty reduction programs we have in history are because the poor are able to become more productive, to use their own capabilities in order to raise their productivity and thereby escape from poverty. And then to be able to do that on a sustainable basis, we have to reduce the variability of the system. Now, the problem as I see it is that if we're trapped in the upper left box, we've got repeated food crises. We're constantly trying to find enough money for the World Food Program to distribute food to the poor who are suffering from high prices. If that's what we're doing, fighting brush fires, fighting crises all the time, not just government policymakers, but donors, the WFP, the World Bank, FAO, USAID. If we get ourselves trapped in that upper left box, we're spending a lot of our financial resources trying to keep the poor from falling into poverty traps, and we're spending a lot of our policy resources and our longer run investments are being utilized in short run management rather than in long run economic governance and long run investments to get that growth process started. And so I think food crises, because they force us to stay in this upper left box, have devastating consequences for the poor, not just because high food prices affect the poor. We sort of accept that as fairly obvious. I think food crises, especially when they're being repeated a lot more frequently than we're used to, are diverting policy resources, investment, development strategy away from what we need to actually solve the problem. And so the poor are getting hurt both ways. They're getting hurt in the short run because of the high food prices, and most of the poor are actually hurt by high food prices. There's some that, if Scott Rozelle were here, he'd argue that in China, peasants have surplus production even though they're poor. It's good in China. But take China out. Most of the really poor households that I know about are actually net deficit and therefore probably hurt by high food prices. But that's a short-run household-level thing. I want to argue that there is a longer-run pernicious impact of these crises in terms of diverting attention from what we really need to be focused on. So how do we get out of this? I mean, what's the way forward? My colleague Frank Galtier at Montpellier and CIRAD in France has come up with a really quite elegant little framework for thinking about it. We just divide it into our 2x2 cell. The objective of policy can either be to stabilize prices or to cope with, reduce the effects of the price instability in terms of welfare. The governance of this is either market-based or it's public. That is, it's something that happens through the private sector or it happens through the government. So those are just the four cells that we get to think about. And these are just the A, B, C, D categories. Category A is private sector-led, market incentivized investments that actually have the impact of stabilizing prices. Now, what do you well, storage facilities that will even out seasonal instability. Transportation systems, trucks, warehouses, and things that allow you to even out the geographical variance in prices. And these are all things that you make money doing. Because seasonal prices, the harvest low price, the pre-hunger, the hunger season high price, if you're good at this, you can make money as a private actor buying low and selling high. And the more of you who do that, the more you even out the price, because you bid up the price at the low point and you bring down the price at the high point. That stabilizes prices, and that happens through private sector investment. To reduce the effects of the remaining price instability in the market, we can use insurance or hedging or futures markets or other more exotic derivative instruments. So that's what the private sector has on offer as a way to either stabilize food prices or to cope with them if there's remaining instability. When that fails, and we still have food crises, as obviously we still do have food crises, then the recommendation has been over the last 20 years, as we've moved to much more market-oriented development strategies and away from government engagement, the whole liberalization movement and deregulation movement. When A and B instruments aren't enough, then we go with D instruments. The public sector, the government, will then step in with publicly funded safety nets that are targeted at the poor who are being hurt by the food crisis. So the Washington consensus, if you will, for the last 20 years or so has been ABD. That has special meaning for some of the folks here, I suspect. It's in academia, it's not a great term. I mean, you really don't want to be ABD all your life, but all but your dissertation. Category C, where the public sector, the government, actively intervenes to stabilize prices, has been pretty systematically dismissed over the last 20 years by the donor community, the academic community, and by many governments as just not desirable or feasible. We don't want to use buffer stocks. We don't want to use import-export controls. Unless there's a food crisis, in which case we jump in often with fairly crazy interventions that use import or export controls or efforts to build up buffer stocks. So when we get into trouble, category C kind of pops back up. And my question today is, couldn't we think about this a little more systematically? Couldn't we prepare governments to do category C interventions better? Instead of saying, no, don't ever do it. If you do it, it's really bad. It's going to destabilize everything else, and it's bad for your budget, and it tends to be corrupt. So don't do it. Where does that leave the World Bank when it offers that advice? Best practice advice is ABD. Don't ever do C. But then when a country does C, where does that leave the bank in terms of being useful or helpful or influential? The answer is they're a laughingstock at that point because they haven't actually been able to cope with what the reality on the ground is for governments being pressured politically. This is not an economic decision. This is a political decision. So my question is, isn't there something that we can do to improve the efficacy of type C interventions? And it turns out there's some historical experience with this problem. Roz noted, I'm actually trained as an economic historian. I co-taught the PhD course in economic history at Harvard, which was also the introductory PhD course in economic development. We taught economic history and development as one field. That is to say, we think there is a historical dynamic, a path dependency, if you like, to the process of economic development, so that static short-run cuts at problems probably don't identify the kinds of strategies and processes that need to be put in place. My task in this course was to try to understand industrial revolutions through the lens of the agricultural sector. What was the role of the agricultural sector in stimulating a country's industrial revolution, and what happened to agriculture in return? You can't answer that question without a general equilibrium understanding of that process. And I picked countries for which the economic historian community had actually constructed CGE models roughly around the time period that I was interested in, that is in the early industrialization stage. So we looked at the Corn Laws in Britain just prior to repeal. So Jeff Williamson had actually built a CGE model of England with and without the Corn Laws in 1836. Then look at France, where the French for a couple of centuries had been worried primarily about provisioning Paris. That's the title of Robert Kaplan's wonderful history of that process. How did the French feed Paris? And how did the political system squeeze the peasants enough to get the grain they needed to keep bread in the market and keep the streets quiet until 1799? How did they manage to do that? And it turns out that the Corn Laws, which both protected English agriculture, corn being wheat, protected the wheat farmers and stabilized. It turned out the way they implemented the Corn Laws was a stabilizing device as well as a protection device. But England was unique in early European history in protecting its agriculture and providing some stabilization at the farm level in prices. And France was really quite the paradigm of trying to keep prices low, trying to feed the cities, exploit the farmers as much as you can. And it took, as it turns out, more than a century for French agriculture to catch up once they gave up the provisioning and basically adopted a pro-agricultural stance. We then looked at Germany, where the pact between steel and rye, Bismarck's development strategy for Germany, was very consciously an act of the state to develop both industry and agriculture and intertwine them as a development strategy. To Russia, then to the Soviet Union, which used forced extraction. I mean, literally, they got away from the market and just forcibly extracted the surplus from peasants. That turned out not to be sustainable. One of the reasons that whole economy came down. Then we did Japan, and Japan consciously in the Meiji Restoration, late Tokugawa, but into the Meiji Restoration, trying to figure out how to raise the productivity of those small farmers, not because they were really interested in the welfare of small farmers, as it turns out. What they really were interested in was getting them to be more productive, being sure there was enough rice in the economy, and that they had a tax base that they could use for the government efforts to industrialize Japan. So we think of Japan as helping its small farmers, and it did help its small farmers. It did raise their productivity, but it wasn't because they were trying to make small farmers even wealthier. So much for historical perspective. Here's the problem that we're looking at. This happens to be a slide that I took from a paper I got a couple of weeks ago from Luke Christensen, who's at the World Bank. And he's just reporting the World Bank's forecast for wheat, rice, and maize. The slide says it's in constant $2,000, but actually it isn't. These are nominal prices. But the point is pretty clear no matter what. There's a lot of variation, especially in the red one. That's rice prices. And the forecast is that the prices are going to stay pretty high, especially he's got the rice price staying pretty high. So that's sort of the what the reality is that we're looking at. I'd rather look at this picture, and from here on, I'm going to be turned into the rice specialist that Roz was talking about. On one of my multiple flights back and forth from Asia, I was coming back from Indonesia after having spent a particularly difficult couple of weeks there trying to get the Food Logistics Agency to do the right thing. And the guy next to me in the seat says, well, you know, what do you do? And I said, I stabilize rice prices. I mean, that's what I do for a living. Actually, it wasn't my living. I was still teaching. But I'm primarily interested from here on in the rice economy. I'll have some things to say about the other commodities as well. But for now, I want to really focus on some of the things I know about. This is 108 years of price data. This is deflated. The vertical axis is a logarithmic axis, so it doesn't really tell you anything. But what's, I think, pretty impressive, and if I were to put the corn price and the wheat price with the same time period and the same estimated trend, it looks very, very similar. There are different peaks in different years and things, but you've got this powerful downward trend over the last century in the real price of rice, and a tremendous amount of variation around that trend. But what I find particularly revealing is out at the far right end of this, the last 10 or 15 years. From about 1995 forward, rice prices really started to fall, and they fell a lot until about 2002, as China and India were destocking. They were basically, they had huge reserves built up, and they lowered them. You know, if you have to consume more rice than you're producing, and that's what's going to happen to prices. As prices are falling, you want to get rid of stocks because it doesn't make sense economically to hold very large stocks in a falling market. And so as prices are falling, they have greater and greater incentive to get rid of more of their stocks. And by getting rid of more of their stocks, they drive the price down. So that's the nature of the world. When they stopped destocking in 2002, then things start to turn around again. And if I had the current world price on there right now, it would be almost where that red line is on the far right side. We are almost back to the long run downward trend. The World Bank doesn't think we're going to continue the downward trend. It thinks we're going to be going off in real terms at fairly constant levels. But still, that's a picture of instability in the context of a pretty powerful improvement in productivity and downward trend in real prices. Now, if we don't, you know, I'm not unhappy with the trend. One of the major factors over the long run in poverty reduction is making sure food is accessible to the poor. And so lower real prices is one of the most powerful tools you've got to help poor people. So the trend is nice. But the scary thing is the variation. So if we're going to do something about this, we've got, I think, 5 general issues to be resolved. Roz noted that I've been engaged with the G20 on the French initiative to do something at the level of the G20 to manage food price volatility. That's actually where the title of my talk comes from, because that's what the French want to do. They would like some kind of initiative that will actually be tabled at their meeting in late June that will help the world. They're not really interested in France or Germany or Brazil or even China. They're really talking about the world. They want to help the world reduce the instability, manage the instabilities, do something about the instability that will make the president of France look good. I laid out to the French Foreign Ministry these 5 issues that need to be resolved. If this is what you want to do, you want really to reduce the instability, or at least knock the big peaks off of these prices, you have to answer these 5 questions. First, where is price instability a problem? Clearly at the household level, for households that have to buy their food, a sudden spike in the price of food without a change in their incomes or their money wages is threatening. I mean, to the point where we can clearly identify vulnerable households where a 50 or 100% spike in food prices over a couple of weeks jeopardizes their food intake. I mean, they really do go hungry. And so the sort of the welfare impact that we're seeing health and nutrition-wise would be at the household level. At the national level, this instability is a real political problem. And it's a political problem not because policymakers feel it in any real current way. It's a political problem because a spike in food prices has the capacity to make urban consumers quite angry. They just don't like a sudden jump in food prices, and they often go into the streets and complain. And what we discovered in North Africa in the last year or so is that when they go into the streets to complain about food prices, they often discover that they have other things that they want to complain about as well. And so it's really best, from the point of view of the governments that have legitimate complaints against them, to keep people from having a trigger that sends them into the street. Food prices, a spike in food prices is about the most obvious trigger you can think of, because everybody's got the same, you don't have to coordinate anything. The market price does it for you. Everybody gets the same signal, and you have the same reaction. So the problem at the national level is I think, primarily a political problem. At the global level, the problem is the nature of the signal that is being sent to multinational corporations, to donors, to research institutes. What is the real scarcity value of rice? If 1 week it's $1,000 and 3 months before that it was $300, what should, where should you be putting your investment money in terms of research? Should you be building irrigation facilities? What are the kinds of investments that you ought to be making in the face of this kind of signal extraction problem, to use the term that Robert Lucas uses he uses it in a macroeconomic context. But when investors can't clearly see the price signals that reflect true scarcity of resources and willingness of consumers to buy, when you can't figure that out, you can't make good investments. And if you can't make good investments, then the rate of economic growth falls. And the empirical evidence, I think, is pretty clear on that. So I think instability is a problem at all 3 of the levels in the title. Which are the commodities that need more stable prices? Well, there's been efforts to stabilize coffee, cocoa, sugar, but I want to argue that the only ones you really want to be worrying about are staple foods that provide a large share of calories and that probably have macroeconomic consequences when there are big movements, because those commodities still form a pretty substantial share of the economy of poor countries. A country where the staple foodstuff is 10% of agriculture and 4 or 5% of the economy, that's a big enough, if you get a big price swing on that, that's going to have major ramifications through. But it's also true, I think, that for hunger and poverty questions, the staple foods are where the action is. For malnutrition and health questions, probably we need to think a lot more about micronutrients, sanitation. There's a whole bunch of other instruments out there that we might be thinking about. Stabilization of food prices is probably not a big deal for that. So I want to concentrate primarily on the staple foods, the staple grains. What instruments do we have then to deal with this? Well, you saw earlier, you can build up reserves so that if there's a scarcity, you can pull grain out of the warehouse. If you don't have those reserves, it's not like financial reserves. With financial reserves, central banks can actually print more money, but you can't print wheat. You can't print rice. It actually has to be physically grown and available before you can consume it. And so having physical reserves of grain provides some buffer, that's why they're called buffer stocks, some buffer against the shortages on the supply side or the surges in demand from the demand side. So larger reserves at some level in that system will be one instrument by which we can stabilize prices. When Chairman Mao was running China, he urged peasants to store grain everywhere. That's one of his famous slogans. Raise productivity and store grain everywhere. And many peasants held a full year's supply of grain in their houses, in their little storage areas. They would keep a full year's supply of grain. So you can do buffer stocks at the local level, at the household level. If you're primarily worried about stabilizing prices within a domestic economy, within India, within China, within Indonesia, within Ghana, within Zambia, then you probably want some reserves that are owned and controlled, managed, and accessible to national governments. And then the question is, well, my gosh, how do you do that in a way that doesn't let them rot, be sold off through corrupt practices? I mean, the management of national level grain stocks is a huge and difficult question. It's one that academic and donor communities have really kind of walked away from. We haven't tried to ask, how do you do it? We've asked, how do you not do it at all? That's a bad thing to do, so we're not going to help you figure out how to do it right. We're going to make sure you don't do it at all. And I think that's just the wrong question. Second instrument are import and export controls. If you're a surplus producer, you've got exports of rice, and the world price starts up, how do you keep prices stable at home? Well, you've got plenty of rice in the country. You just put an export tax or an export ban up and keep it for your own citizens, for their own food security. And there is no protocol in the WTO that keeps you from doing that. It's perfectly legal. You may not like it morally, but it's perfectly legal to do that. You can do import controls if prices are too low. And I worry not quite as much about prices being too low as about being too high, but I do worry about both ends of that spectrum. Countries use border controls all the time. Economists hate borders. Economists would like the whole world to just be one network of roads without any political controls at all, because borders, political controls, get in the way of trade. Trade is the engine of economic growth, and there are gains at both ends. The buyer and the seller gains when trade takes place. Trade is a really good thing. It evens out surpluses and deficits. It allows people to specialize in what they're good at and still be able to buy food. Adam Smith's pin factory is the paradigm. You can't eat pins. You can get really, really good at producing pins, but then you need a market, and you need to be able to sell those and buy other things. Okay? Economists don't like those. Kim Anderson, he spent 10 years helping the World Bank do this major study of distortions to agricultural prices. Now, I think of distortions as kind of a bad word, but any deviation of a country's price from the border price is called a distortion by economists. So you can understand the attitude that we've got about border controls. Third thing we might do, and I'm not going to talk about it, I'm going to raise it. Is there anything we could do to slow down financial the financialization of food commodities, speculation, the hot money from the hedge funds coming in and bidding up the price of wheat and corn, not rice because the futures market doesn't work. In Foreign Policy, in the late March issue, is an article, How Goldman Sachs Created the Food Crisis, by basically inventing the Goldman Sachs Commodity Index and then creating derivatives that you could play with out of that. You don't have to believe the article to think, there's something on the order of $400 to $500 billion of hot money invested in food commodities now. Does that have any impact on real prices? Wally and I disagree a little bit on this. I'm probably more concerned than he is, but I think we all agree that it adds to instability in the market. And if you think that instability is a bad thing simply because it confuses the economy and confuses investors, even that would be bad. But it may be that it's actually driving some of the food price inflation that we worry about. But that's basically it. This is not a long list of ways you can stabilize food prices. The long run way to stabilize food prices is to raise productivity of agriculture, to get farmers to be more productive and make sure that there's plenty of food in the marketplace. That's the long run way you stabilize food prices. But that's a 20 to 30 year investment horizon, not the couple of years to decade that we're talking about right here. Fourth question is, if you're going to intervene, how are you going to govern those interventions? And this has been the big problem with any international intervention, running an international buffer stock, running an international commodity agreement to stabilize the price of wheat or maize or rice or whatever. It's just awfully hard when consumers and producers have very different interests, food price dilemma. Exporting countries have very different interests than importing countries. And so it's been extraordinarily hard to figure out any way at the global level to design a stabilization instrument. Not helped by the fact that in 1981, Newbery and Stiglitz basically showed us that it was impossible to do it in the long run anyway. So there has not been a single serious effort to put together a global stabilization program for any commodity since the Newbery and Stiglitz volume was published. That's 30 years ago. But that doesn't take away the challenge of how would you govern a national level stabilization program. Wally and I worked for Bulog, the food logistics agency in Indonesia, and they actually did a pretty good job for almost a quarter of a century, but the governance of that was unique. I don't know another example, even in Asia, that had the kind of slightly scary but effective governance structure that Food Logistics Agency had. And so I put this up. It's primarily a political economy question, but it's one that I wish we would spend a whole lot more attention on. Rather than saying, don't do it, the question still strikes me as being, how do you do it? Isn't there some way that we could make this a more transparent and efficient process? And then finally, how do you know when it's working? At the national level, to be honest, I think it is primarily a function of whether or not you stimulate economic growth. Thom and I will disagree slightly on whether it's going to stimulate agricultural production. If you can stabilize farm prices, will that have any impact on the adoption of new technology, use of fertilizer, and things like that? Certainly, most of our models suggest that it ought to help, but it's not clear what the empirical evidence is on that. Simple benefit-cost analysis, given how political these processes are in individual countries, probably doesn't get us very far. But if we ever got a program at the international level, I would argue that we would design in from the start a pretty robust benefit-cost evaluation system. And then you know, I mean, you'd gather the data and you would do the analysis. How many? 5 minutes? So let's run through at the local level. First of all, at the local level, I thought Chris Barrett really laid out what you can do for these ultra-poor households and what the intervention systems were. Whether stabilization from above is beneficial or not, I think I'll get there. Throughout Asia, there are efforts to build reserve stocks at the village level as a way of kind of buffering them from national movements. That might be an issue. The social safety nets, to be quite honest, I don't think they work as a solution for food crises. I think social safety nets have wonderfully productive impact when you design them for longer run interventions, but they have a terrible track record at coping with instability and sudden crises. They take time to design. It's really hard to get them scaled up. It takes a year to get the budget approved and to identify who it is you're trying to get to. So I think social safety nets are useful. And if you've already got them in place, you might be able to add funding to them. But I really don't think social safety nets are an answer to the problem we have. I think the answer at the long run is economic growth, higher real wages. That's the sustainable solution. And the challenge then is, well, all right, if that's the answer at the local level, how do we make sure that they survive and have the environment in which they can then participate in that? At the national level, I'm actually a big fan of increasing food reserves. The background paper for this talk spends a lot of time on how to build food reserves, primarily at the regional or national level. I understand that food reserves are incredibly expensive. The Minister of Finance is going to get really upset before very long. But the advantage of countries holding larger reserves of food is that they then feel much more comfortable using trade as the regular basis for either selling surpluses or importing the needs they want at whatever, at the price level that they are defending. The reserves give them confidence. You can't use reserves as a regular source of consumption. That's not what they're there for. They're there literally as the buffer, and so you want to, the whole point of reserves would be to build confidence again in the international market. I'm talking especially about rice, because right now nobody trusts the world market because of all the export bans and import controls and everything else. We use border controls to prevent high prices from coming in. The difficulty, many of you will understand, if very many countries use border controls, the remaining world market gets thinner and thinner, and the price gets much more variable there, which makes more people want to use border controls. And so it's a real vicious cycle into autarky. And autarky is extraordinarily expensive in terms of economic growth. We just don't have any examples of autarkic countries growing rapidly. The real solution is clearly higher agricultural productivity, but we all understand the time horizon. Well, I think all of us understand the time horizon. From the time we've finally decided over the last 2 or 3 or 4 years that we need more investment in agricultural research to raise productivity, to outreach to farmers and all of that, it's really 20 or 30 years before we begin to see a serious global response to those kinds of investments. We can use food subsidies, we can use nutrition and health programs. That's fine at the edges, but that's not going to solve the problem. I think we really need to think more about stabilization. At the global level, there's really not much we can do. We can provide good analysis, make sure the information is out there so that participants are fully informed. Information analysis is global public good. Agricultural productivity investment in CGIAR systems, that's a global public good. There are ways to transfer risk from countries to donors, but it tends to be a crisis response. It doesn't tend to be a regular routine thing that they will rely on. Can we stabilize food prices in world markets? The received wisdom is we cannot, but I would like us to think, at least in the rice context, that there may be regional efforts through coordinated stocking decisions across countries, say under the auspices of the ASEAN +3. They own the stocks themselves. They aren't going to, what ASEAN as a unit is going to own is not going to be very much. But if all of them agree, you know, we all ought to have 10% higher rice stocks because then we trust the rice market a whole lot more. Let's see if we can then go back and get our finance minister and our logistics folks to bring that about. Finally, at the global level, you simply can't leave this off. What's going to happen with climate change? Everything I read from David Lobel says things are going to be a whole lot less stable in the future. And so if there's any way that we could slow that destabilizing impact down, that would be really useful. I'm not sure that there is. I'm going to quickly show you, just because I got to set up Thom, contrasting experiences with stabilization in Asia and Africa. Gosh, I know the Africa folks are tired of hearing lessons from Asia. So I'm going to be pretty careful. But you just need to see a couple of charts very quickly. The red line is what happened to the world rice price. The green line at producer equivalent. The green line, dotted line, is what happened to producer prices for rice in Asia, and the blue line is what happened to producer prices in Africa. A whole lot bigger run-up in prices. Asia did more to stabilize. Here's contrasting experiences within Asia. The blue line is the Indian price of rice. The green line is in Dhaka. And normally, the Indian price predicts the Dhaka price very closely because they've got an open border, and whenever Bangladesh needs imports, they get it mostly from India. But when India put the export ban on, you can see suddenly the Dhaka price jumped up. They no longer had that ready access. They still didn't go up as far as Thailand. Thailand jumped up because India put the ban on. But you can see that Asia was reasonably successful at stabilizing. This, to me, is astonishing. Here's Malawi with white maize. The green price is the price in Malawi. The red price is the South African white maize price, and the black dotted line is it's not Chicago, I think it's Gulf maize, U.S. ports, yellow maize. Now here, this is a world I simply do not understand. The domestic price is way more unstable than the world price. And you would be hard-pressed to find a single country in Asia where that was true for rice. So there's something really interesting going on here. And it's despite the fact that at least in Mali and Senegal, the rice price is a whole lot higher, but they still had big responses. What do? You help households to the best you can, but that's really got to be a long-run solution, I think. I think we should help countries stabilize domestic prices and try to figure out how to minimize the spillover when they do that. Just announcing what a tariff schedule is going to be if you're an exporter or an importer that you're going to use to stabilize your domestic price, and make it transparent. Get that info. It's the difference between uncertain and unpredictable. You can make it a whole lot more predictable, and that might well bring confidence to, at least to the world rice market. The regional organizations, I don't think ASEAN's ever going to have an effective stabilization program, but they might well be a talking forum where they could say, you know, we all need to figure this out. And finally, I think we need to treat stable food prices as a good rather than a bad. So, what's the right price? $400 a metric ton, 25% brokens, FOB Bangkok or Saigon. I'm actually dead serious. That is the right price for rice. Right now, you can buy it for $4.45 out of Bangkok, $4.50 50 out of Saigon. So we're about 10% too high at the moment, but we're not that far off from what probably the right long-run price for rice is. Thanks very much.
Thanks, Peter. So our second speaker is Thom Jayne, who's just going to give a briefer commentary, and then we'll open it up to questions. Thanks.
Thank you. Thank you, everybody. It's a pleasure to be here today. And I just wanted to start out by saying that 20 some odd years ago, when I was a graduate student, I read a whole bunch of Peter Timmer's work back in the mid to late 80s. His work was peppered in the syllabuses that I read, so learned a lot from him during those years. And I find myself in a particularly ironic position disagreeing with a whole bunch of what he said today. So if you'll allow me, I will try to point out why that is. There's many things I also agreed with as well, so I need to be honest about that as well. So let me start out by summarizing what I think was what I heard Peter saying. 4 main points. First one is that food price volatility is a major economic problem. Price stability contributes to growth, okay? I think that's a central part of it. Another one that he said was that price instability is a major political problem as well, and that policy analysts, in order to be relevant, need to face up to these political issues. If they don't, they're not going to be taken seriously by policymakers. That's point number 2. And then this is a point that I took off his paper, that we need to be giving greater attention to second best outcomes. And for those of you who are non-economists, second best outcomes are kind of bad English, but it's that the most appropriate, the optimal set of policies may be infeasible for one reason or the other. So we have to be sort of practical and pragmatic and go to the next best alternatives. And then in terms of what to do, he talked about helping households cope with price risks, helping countries stabilize their domestic prices with minimal spillover to global markets. He's talked about this at length just a moment ago. And then even though he kind of backed off a little bit during the presentation from this, he did in the paper talk about helping regional organizations provide productive forum for coordinated regional, international food reserves, okay? So this is what I think is the core of what Peter has just laid out in the last 50 minutes. So I'd like to tell you, well, let's start with that first one, point number 1. Price volatility is a major economic problem, and that contributes to economic growth. I agree with both of these points. So let's encourage governments to stabilize. Now here's my concern. Price stability definitely seems to contribute to economic growth. I think the evidence is pretty strong on this point. But price stabilization efforts don't necessarily contribute to price stability. And there's a lot of evidence out there that unfortunately, points this up. Government's track record in stabilizing prices has been mixed at best. And I always hark back to my initial experience working with peasant farmers. I was a Peace Corps volunteer in Ghana in the early 1980s. And I could see firsthand how the best efforts of peasant farmers who I was living next to could be undermined by the stroke of a pen by some politician in the capital, ostensibly to stabilize prices or to do something to protect, producers. But the actual impact of that was just the opposite. Often there was rent-seeking patronage activities really at play here. And then in my later work as an economist, I just was working with Anthony Chipoto, someone in Zambia that I work with. We were looking at the degree of price instability that different countries in Africa were experiencing. And as you can see from this figure up here, the two countries with the highest level of price instability, and this vertical axis is the coefficient of variation of food prices. The two countries with the highest level of instability are the two countries that are most actively involved in price stabilization in the region. Malawi, which Peter put up that graph for Malawi, and Zambia. And it turns out that these are both landlocked countries. So is Addis Ababa, 1,000 kilometers from the port. Nairobi, 600 kilometers from the port. So certainly the issue with price stabilization is that the jury is far from being resolved as to whether all the money spent on stabilizing prices is actually effective. Okay? So the relationship between price stabilization and economic growth in my reading of the literature is tenuous at best. Peter has said that there are massive costs involved with price stabilization programs, and that represents foregone investment in other things, which I'll come back to in a moment. And then let's not forget, taking a political economy perspective, that a lot of things that are done in the name of price stabilization are really just rent-seeking behavior that it's a fact. So my conclusions from this is that despite being very much persuaded by Peter's point that price stability contributes to many important objectives, efforts to stabilize prices sometimes don't produce those outcomes. And that I have not seen solid empirical evidence presented that shows that greater productivity growth results from price stabilization efforts. I actually think the onus is really on Peter to sort of make that case more clear and back it up empirically on that one. Okay, now Peter's second conclusion is that price volatility is a major political problem. I don't think anybody in the room could disagree with you on that point. Policy analysts need to address these questions seriously and the need now for second best outcomes. Now, my concern on this is that there is a lack of clarity about what the fundamental problem is. I think Peter has indicated that it's high food prices which are causing most of the consternation and most of the stress, most of the difficulty that are being experienced. And high food prices is not the same thing as price volatility. I will get to this in a moment with a graph. Most analysts show that it's high food prices that are the problem as well. So I think we talked about this Barrett and Belmar piece over lunch. I found it very persuasive, but the three people I was having lunch with didn't. But anyway, Belmar and Barrett found that we could find no rigorous evidence that political unrest is due to price volatility. They did say that that political unrest was very high, correlated with high food prices, the level of food prices, not necessarily the volatility per se. So the evidence that stabilizing against low food prices helps producers, I take that point. But it may end up being regressive. And let me point that out by using some data that I've worked with in Zambia. I'm living in Lusaka and working with the Central Statistical Office in that country, which is the equivalent of the Bureau of Statistics here in the US. This was a survey of 8,000 small farm households. And just to give you an impression of the winners and losers from mean raising price stabilization, let me walk through these numbers. First thing we did was looked at who accounts for the top 50% of all of the maize, that's the staple crop in Zambia, all of the maize nationally sold in Zambia. It turns out that there's 30,000 households out of 1.5 million households who account for the half of all the maize sales. The point is that the surplus in these countries is very highly concentrated among a small proportion of farmers. I put the percentage here. 2% of farmers account for 50% of all of the maize sold in that country nationally. Now, there are other maize sellers, small maize sellers selling 1 bag, 2 bags, 3 bags. And there are 30% of them, another 500,000 households. But the vast majority, over 2/3 of all of the smallholder farmers in Zambia don't sell any maize at all. They're buyers. Most of them are buyers. And these numbers are very consistent with surveys in Kenya and in Mozambique and in Malawi, and in fact, everywhere that I have looked at household survey data on the continent, it's very similar to this. Why is this? Well, look at farm size. There's a clue. The ones who are commercialized are, again, the small proportion of commercialized households have 7 hectares compared to 1/3 that size for the smaller households, and 1/6 that, or 1/7 that size for those who don't sell. Asset wealth, this is the value of plows, harrows, scotch carts, irrigation equipment, and so forth. Very skewed as well. The gross maize sales, these households, the 2% that are highly commercialized, they make about $3,000 per year selling maize compared to 0 for the vast majority. But it's possible that these ones here in the bottom, it's possible that maybe they're not producing maize, but they're surplus producers of something else, tobacco, cotton, groundnuts, and so forth. So let's look at the gross value of total crop sales. Doesn't look very different, does it? Now, it's possible that these households are perhaps not involved in agriculture very much. Maybe they're deriving the bulk of their income from non-farm activities. So after looking at total household income, the picture looks pretty bleak as well. So the point here is that these ones down here, the most land-constrained and asset-constrained households, poverty is rampant among that group. Now, those are buyers of maize. Think about what the impact, the distributional effects are going to be when the government comes along and pushes up maize prices ostensibly to protect the farming population. All of these people are farmers. Who wins and who loses from such efforts to do so? Well, it's pretty clear that they have regressive distributional effects on the poorest households. There are going to be some winners. The ones who are going to be winners are these ones, and secondarily these ones. Looks a lot like the United States, doesn't it? Where a small proportion of the farm population gets 50–70% of all of the subsidies that are weaned from the U.S. government. So there's a lot of similarities to this picture. The point is that, at least in a static sense, efforts to raise food prices tend to be regressive. I am in agreement with Peter that if prices go too low beyond some certain level, that's going to be a problem for everybody in the long run too. So I totally agree with that. But I think we need to keep in mind some of the adverse distributional effects on poverty that can result by efforts that are currently afoot right now to raise food prices in many developing countries in order to protect farmers. Okay? Is there any evidence that food prices are becoming more volatile? Now, here's another version of the same graph that Peter put up earlier. I'm taking the long run here, 1960 all the way up to 2007, or no, so 2009. So it does take into account the 2007-8 food crisis. These are nominal dollars. Let's take a look at what these food price trends look like if we deflate them by the global deflator. I'll do that in a second. Anyway, looks like there's 3 regime shifts during this time. Prices ramped up to a new mean level from 1972 onward, and then in recent years it looks like there's a new regime shift at play, whereas there's an 80% rise in food prices, but there's no change, believe it or not, in the coefficient of variation around those prices. Okay? Certainly a regime shift. Now I'm going back to the global deflator. I think this is very interesting because it shows that over the long sweep of 4 or 5 decades, the price of food, at least relative to GDP growth, has declined a lot. And Peter, one of his points was that in the long run, it's productivity growth, which I totally agree with. But in the short run, there's so much poverty and instability that 20, 30 years down the road is too long. Well, if we were saying that right around 1970, we would have said, well, long-run productivity growth, are going to get us to here. I think that we've made a lot of progress in the past 20, 30 years compared to where we were in the 1970s about the price of food relative to purchasing power. So I would like to believe that, that maybe the long run has happened and that there's still certainly a lot of stress. But I think we need to acknowledge that at least in real terms, even when you look at Africa, which hasn't experienced as great a productivity growth as other developing areas are, even if you just look at Africa, still the price of food has not only become lower, but also more stable. So if you look at these last 3 years down here, where there's been a lot of instability in nominal terms, still at the peak of this 2008 food crisis, the price of food was about equal to where it was in 1996 in terms of purchasing power, at least compared to GDP growth. So things are getting a lot better over the sweep of history. But GDP deflator is a gross measure. So let's look at purchasing food affordability. Nikki here, who's working with me, she and I put together an analysis that just got published in Food Policy, looking at how many kilograms of food could an average consumer in Zambia afford on a daily wage. And daily wage is a vague concept because there are many different daily wages. So we used 5 different versions of wage rates. And then this axis shows the kilograms that can be purchased on a daily wage. And the point of this is that from 1994 all the way up to about 2007-8, there's been some pretty dramatic improvements in purchasing power for food in Zambia. Let's look at bread, pretty much the same thing. There's been pretty dramatic improvements. Now, after the food crisis, things backed off a little bit, but still, let me go back to maize, where things were in 2009 is a lot better than it was over most of the past 20 years. So affordability seems to be improving. In Kenya, it's not quite as good. There's some indications that things have gotten a lot worse in recent years, but still, even in 2009, the amount of food that could be purchased on a daily wage is quite a bit higher than it was for most of the past history, where we were collecting data on this. And here's another point that I think bears, this is from the World Bank, bears repeating. This is poverty rates in blue. Right around 1990-92, there's been a pretty dramatic fall in headcount poverty rates in sub-Saharan Africa. And at the same time, there's been pretty dramatic increases in purchasing power. So a lot of this, I think, explains why these graphs are the way they are. I read an article recently that Africa's middle class is rising dramatically. It was 50 million people in 2000. It's now 200 million. So a 4-fold increase in the number of middle-class households in Africa in the past 10 years. So my conclusion is that, yes, food volatility is a problem, but there's little evidence to suggest that it's becoming more of a problem. In fact, the evidence is probably pretty strong that it's becoming less of a problem over time. I agree that farmers producing a surplus are certainly hurt by low prices, but efforts to raise them, to the extent that they're successful, can also have adverse distributional effects that we need to take into account. High food prices is the major problem, and that the strategies for addressing high food problems are different from the problems for addressing volatility. Peter's rightly said the problems for addressing volatility have to do with buffer stocks and trade controls, whereas the strategies for addressing high food prices is to increase productivity. So let's take a look at the evidence on what it is that tends to have the greatest impact on productivity. There are two studies that I'd like to draw from. This first one is done by the Economist Intelligence Unit. This was published in 2009. It was funded by the Gates Foundation. It's a very interesting meta-study of ranking public investments and policies in terms of reducing poverty and improving agricultural growth in Asia. I think it incorporates 6 different countries in Asia. And this second study that I'm going to talk about is from IFPRI. It's done by Schengen Fan and colleagues, looking at India, I believe, in particular. Here's the rankings with respect to agricultural growth. The Economist ranks policy number 1. And by policy, by the way, they mean basically liberalization policies where there were strict, heavy government controls in many of these countries, and those have been relaxed over the last 2 or 3 decades, 4 decades. So they put policy number 1, but there's pretty much agreement on the productivity-enhancing investments after that. It's investing in roads to reduce transport costs. It's R&D. What is that? That's crop science. That's investing in agronomic research, things that will help small farmers to become more productive, extension services, and so forth. And now, this is with respect to agricultural growth. When you look at the rankings with respect to poverty reduction, the rankings are not very different. Number 1 from the Economist Intelligence Unit still comes out to be liberalization policies. Road investment and so forth, that's all right up there as well. So here's what has probably contributed to this right here. Because, as you know, there's been pretty dramatic changes in Africa away from government-controlled systems to more liberalized ones since about 1990. Peter's opening question in his paper was, is there any way for good economics to be politically sensible? And Peter's conclusion is that good economics must take account of political realities. He made that case very compellingly. Policy analysts will be ignored if their prescriptions ignore government's preferences for price stability. I agree with that comment. My conclusion, however, is not to give in quite so quickly to second-best approaches. There are many important policy changes that this world has experienced over the past 5, 10, 20 years that no one thought would be possible until they actually happened. Economic reform in Eastern Europe, the breaking down of the Berlin Wall, just what's happened over the last few months in many Middle East countries. Who would have thought that could have happened? And same thing for economic policy reform in many developing countries. Who would have thought back in 1985 that we would have a fairly open system in most sub-Saharan African countries now with macroeconomic stability, with, you can go right to a bank and very little black market control of currencies anymore. That probably wasn't envisioned 20 years ago, nor was this resulting effect from all of those policy reforms. So I would say let's not underestimate what can be achieved by good analysis and good outreach, good policy dissemination. Let's not underestimate. Wasn't it Keynes who said something like many politicians don't realize that their own viewpoints reflect the mad scribblings of some economist 5, 10 years ago? Somehow these ideas really do get into people's ears and they have to take account of them. So I would like to think that there's more scope for going after the first best set of policies and taking the second best ones only when necessary. Now, what to do concretely? Peter's 3 or 4 points are to help households cope with risk, drawing a lot from what Chris Barrett had mentioned earlier. certainly very rational points there. Helping countries stabilize domestic food prices with minimal spillover, and helping regional organizations provide productive forum for coordinated food reserve policies. And then your last point there, taking stable food prices as a good rather than bad. Okay, my list of concrete actions would be slightly different. One would be to encourage a shift in public budgets away from stabilization per se and into the kind of things that promote long-run productivity growth that can sustain the kind of benefits that I've shown you up there about reductions in poverty, increases in income, and lower real prices of food over time. What are those investments? Sound macroeconomic management. That's a central part of the success story in recent years in Africa. Let's get the continued productivity growth out of agricultural research, more fertilizer-responsive seed, more productive use of fertilizer, viable farm extension systems, basic education and health. This is not agricultural intervention per se, but this is an adjunct that really influences the productivity of agriculture, basic health, basic education. Infrastructure, as the Economist report and the IFPRI report highlighted, these are some of the things with the greatest payoffs. Sustainable use of the world's water supply, and how to maintain crop productivity in the face of climate change. These are the kind of investments that promote long-run income growth and long-run increases in affordability to food. And they're part of what has accounted for why food prices now in 2011, despite being so high, food prices so high in 2011, are still more affordable to most of the world than they ever were before. These are the kind of investments that we need to keep making. Does anybody know what this is? Here's my pop quiz. All right. This is a border between Malawi and Mozambique. This is what the border looks like every day. Now, why does it look this way, and what are those people doing with the bicycles? There happens to be a 20% import tariff on maize coming into Malawi. That's the reason why food prices are so high during that period. And the way to evade paying that 20% tax is for the traders to bring their maize from the export country, that's Mozambique, over to the Malawi border. They offload that maize off the truck. They take it one bicycle at a time, across into the Malawi side of the border, where there's a truck on the other side waiting to load the maize back up and then take it to Lilongwe. This is what the trade controls that are ostensibly used to help stabilize prices. This is what the impact of such things are in this particular instance. Now, who gains and who loses from this? The government put this tax into place in order to ostensibly stabilize food prices. But the actual beneficiaries of this are the people who are these bicycle traders, because they're the ones who are getting some commission for moving grain across. But the big losers are farmers in the exporting country who get a lower price for that maize, and consumers in Malawi who have to pay a higher price for that maize due to all of the transaction costs going on here that are passed on to both producers and consumers. This is an ostensible price stabilization measure which really has unfortunate consequences for everybody. So why don't we go after the low-hanging fruit? I think this is low-hanging fruit. Abolish that thing. You know, nobody's going to lose except the bicycle traders from such a thing. What to do in the short run? Let's distinguish between emergency reserves and buffer stocks. The former, emergency reserves, are very important. They're smaller. They're meant to buy some time. They're meant to buy, so it takes 2 or 3 months to get imports in to a place like Malawi. So emergency reserves are necessary. But the latter, the buffer stocks, are explicitly meant to stabilize prices, and so they need to be large. And as I started out, there's an extremely questionable track record about the ability of most developing countries to do this. I find Peter's point compelling, that maybe we need to help governments do this better. Okay, thanks. Do this better, and I think there's some potential for that. I'm told I need to hurry up here, so let me just go. I've talked about safety nets as well. I think they're part of the issue. What not to do? Last slide. I'm fairly skeptical about the ability of large-scale government buffer stock policies to accomplish their intended objectives, partly because of the management and coordination necessary, but also because of political economy issues that often get in the way, not just in Malawi, Mozambique, but in our country too, where there are, it's not, the ethanol policies that we have in this country are not the result of bad management, but obviously they have a lot to do with vested interests and things that are difficult to unwind politically. I'd rather not get Africa into that kind of position where we need to deal with those kind of issues. Zambia, the country I'm living in, lost $300 million this past year, 2% of its gross domestic product, due to its maize price stabilization options. That's a huge opportunity cost that I think we need to take extremely seriously in terms of what wasn't done but could have been done with all that money. Stabilizing well could be good economics, but stabilizing badly is neither good economics nor good policy. So on those points, Madam Chair, I'd like to thank you very much. Okay.
Thank you, Thom and Peter. Before we get started, I just wanted to make an announcement that there will be a reception at 6 o'clock after this session. So if you do try to answer or ask questions that aren't answered, there'll be plenty of time with the speakers and with each other to talk about these issues. I also wanted to say that all of these sessions are online. The past 3 sessions that we've had are already online. The videos are online, as are the PowerPoints, and this one will be within the next month. So as you're thinking about your questions, I'm going to take the privilege of being the moderator to ask a question. And I think what you have both raised is some really interesting juxtapositions with the Asian experience and the African experience. And there hasn't been much conversation about the private sector and how the private sector has developed in each of these cases and how it interacts with the public sector. And I think it's a really key point in terms of price signals and so forth. And the other thing I think is important is governance. Obviously, we've heard that rent-seeking behavior is such an important aspect, particularly in the African context. And Peter, the work in Indonesia, although there's a lot of corruption in different countries, including Indonesia in the past, I think the technocrats that coordinated between finance, ag, trade ministries and so forth were able to construct a policy that led to good stabilization. So maybe if you could both touch upon those issues, and then we'll open it up for questions. Thanks.
Please.
Well, let me start by saying, basically, I agree with Thom. I put that Malawi slide up because I just don't understand how those food systems operate. I would argue that his list of the essential things, starting with the macro management and going down, I totally agree. The country's got to get those things right. Having done that, food price instability in a large country can be seriously destabilizing, both economically and politically. And my perspective, coming from Asia and working in really big countries, is we could have helped them a whole lot by helping the stabilization effort at that point, given that they're growing at 8 or 10% per year. They've got a land distribution that looks a whole lot different than Zambia. So my sense is if a country is at a stage and has the governance capacity to really want to stabilize its food prices, we ought to be helping them rather than telling them, no, no, that's a bad thing to do. Look, bad stabilization is worse than no stabilization. No question about that. But that doesn't mean we have to live with bad stabilization. So let me leave it at that.
Okay. I can't add to that. I agree with that point. So I think in the sake of time, let's move on to the next one.
Do you have any comments about the private sector? As if it's absent, I think, in the talks, and yet it's really important in terms of how it does move buffers.
Okay. One thing to say about that, but can I go to the slide? I want to go to one of Peter's slides on this. This is the Gaultier slide. Yes. Would it help to do that?
ABCD.
ABCD.
Remembers ABCD.
All right, fine. I won't go on to that. One of the things that well, now we're going to Frank Gaultier, but this scheme of the 2x2 matrix, if you recall, one of them on point C, which is the one that the World Bank stays away from, is on stabilization from the public sector. You made some very compelling points about that. The one thing that bothers me about, or needs to be put in, I think, mentioned, is that going to put this to category C interventions has an impact, and I would say a rather chilling impact, on the investments in category A and B, the private sector's willingness to invest in stabilization activities that are of the A type and of the B type. And it's basically crowding out of some kind. If government is going to prevent certain price rises from occurring, then what's the incentives to invest in storage? If you're not going to be able to capitalize a little bit on the upside prices. So I think there's abundant evidence that that kind of crowding out is occurring in many countries in Africa where the government is attempting to stabilize prices, like Malawi. And like
but that's just incompetent government. Indonesia, China, India have all been able to put bans on that actually encouraged investment by the private sector because it helped them see what the rules of the game were and then lived with those rules of the game. And you end up with a much more dynamic and actually a smaller scale private sector, which I think is a good thing. It's not a couple of big monopolies. It's a lot of smaller competitive firms. But if you can establish what the rules are and make it clear, you've got to have margins that are big enough to make that private sector profitable. The problem with so much of the African efforts is that they basically had negative margins. I mean, they don't want the private sector in there. They do everything they can to squeeze them out. But a stabilization program designed around trying to enhance the ability of the private sector to participate is sustainable in the long run, and gradually it actually works the government out of that task.
Great, that's what I was hoping you were going to talk about. Questions, please. Any questions?
No questions.
Wally.
Probably, well, it's not clear what both of you agree and disagree on on this point, to be continued. But it seems to me that one of the things that you would both agree with is if some new set of rules can be put into place about export bans, getting new protocols for the WTO, et cetera. Is that in the cards, do you think? Has the export side of the trade in commodities, is that something we should look forward to in the next few years?
Well, I can speak to regional issues in Eastern and Southern Africa. There's the Common Market for Eastern and Southern Africa is trying to get their member states to not have any trade controls at all between their 21 countries that are in Eastern and Southern Africa. Right now, it's a very mixed success. I would say that well, I would agree that their goals are laudable and would improve both the welfare of producers and consumers, if they could achieve it, I think it's some time off before we're going to get there.
Well, for rice, it's not a chance in the world. I mean, even ASEAN can't agree on even allowing rice to be entered into the negotiations on free trade within the ASEAN region, and they're moving pretty rapidly on freeing up a lot of other things. I just can't see the exporting countries giving up the political right to defend their own citizens in terms of food security. Even if they will sign off on a protocol and ratify an agreement, they won't live with it. And so it's in that sense that I talk about second best. Now, I totally agree that if we could do away with the need to have those, and so that's why I'm trying to get people to have slightly larger reserves. If you had larger reserves, you wouldn't resort to those kinds of trade barriers. We could keep the borders open. Look, open borders are good things. Okay. Look at Mozambique and Malawi. Open borders are good things, and there's ways around trying to close borders. You know, the old saying is, God meant Indonesia for free trade. Thousands of islands that you can move in and out of. So, but just politically, I think it's impossible to tie the hands of countries that are threatened politically not by high prices, by suddenly high prices. It's the movement in the price, not the level of the price, that's actually the problem.
Okay. All right. For an exporter, I have a question, follow-up for you. For an exporter holding buffer stocks, I can see how they would do that. How would a chronic food importer, what would be the way by which they should accumulate their reserves?
Import them.
Just import them and hold them? Why not import them when they need them?
Because at least with the world rice market, when they need them, it actually disappears. India bans exports, or Thailand bans exports, and you're really stuck then if you are a regular importer and don't have the reserves to get through that six-month period.
And our prices, production so covariate between all of these different countries that when Indonesia needs to import?
El Nino is a pretty widespread phenomenon, and that's where the real production variance comes out of that system.
Okay. And then what'll happen? China used to import about 3% of its food needs, and that's rising rapidly, and that's 6% now. Let's say that next year China has to get into the market in a big way, and they import all their needs, and their needs are much greater than the capacity of the rice market to absorb it. Supposing they do that, and what do you think the response to everybody else in the world will be after that?
They will be very unhappy with China.
What
it will foster is really big investments in autarky and local self-sufficiency. It'll be, as you will, I think, agree, it would be a disaster for the long-run health of economic growth and the world food economy. Actually, China knows that. So I don't, even if there's a serious blowout, I think it's going to be wheat rather than rice in North China. Even if there's a serious blowout, I don't think they're going to come into the world market in a big way. They're just too aware of how big they are in that market. Soybeans are a different story. I don't think they feel that people watch that nearly as closely.
Interesting.
Let's have a few more questions. David?
Yeah, okay, it's on. So you both agreed, and I think most of us agree that on the 10-plus year horizon that increasing productivity is really important for a whole lot of reasons, but partly for the reasons we talked about. I just wanted to unpack that a little because there's a lot of productivity enhancements in agriculture that don't do anything really to the variability of production. And then there are things like irrigation or drought-tolerant seeds that can actually lower the CV of production while it's increasing productivity. And the question is that an important distinction? In other words, is the variability of local production a major player in these price volatility, and is that a strategy that's worthwhile, or is this not not an important part.
My own take is that much of the price instability in Africa is local production systems instability, whereas much of the instability in Asia is not local production instability, it's global market price instability, and they're trying to protect themselves against that. But Asian agriculture, and rice in particular, is so much more heavily irrigated than any of the African food systems.
So maybe a way to ask Thom is that your chart of the IFPRI and Economist study had irrigation quite low as a productivity enhancer in general. But if your goal is to improve productivity and reduce volatility, maybe irrigation rises a little bit higher in that way.
Well, I'm glad you asked that question, because you started out by saying that some of the investments that will promote productivity may not change volatility. Yeah, but I think that the key point there is that by promoting broad-based productivity, you're promoting rural incomes and structural transformation processes that raise living standards and therefore make it more affordable to deal with volatility in food prices. So one of the reasons why food price volatility is less of a problem, why we don't riot on the streets right now here in Palo Alto, is because living standards are high enough that we can absorb this without too much difficulty. And it would be nice if many developing countries, through the income growth on their own, through productivity growth and income growth, would have the same situation. So I think that that's the goal.
Let me push David just a little bit, because it seems to me that empirically it may actually be true that even when you've got production technologies that don't change the instability of the crop itself, by raising productivity you change the degree of instability in the price. And my guess, this is an empirical question to whoever wants to do a nice paper, what's the relationship between instability in crop prices over time? And Thom said it doesn't look like it's getting more volatile, but let's try some different definitions and look at this empirically and correlate that against the rate of advance in productivity of that crop on a global basis. So look at world prices, maybe quarterly, against the productivity gains in that crop. My hypothesis is in eras when productivity in wheat or in corn is rising rapidly, you don't have a whole lot of volatility in price. And when productivity growth is lagging, you do get a good deal of volatility. And I think I've never actually seen those matched up, but I think that would be a very interesting comparison.
If there's let me just try to add one more. If there's a way to target investments that both increase productivity and reduce the instability of output and so forth, great. That's a win-win situation. Otherwise, there's some kind of trade-off. And so I guess that we need to figure out what the nature of that trade-off is for each of these kind of investments. Yeah.
I have a great paper you should read by David Lebel in Nature recently. Well, I think it's just been, I think, it's a relevant question when we look at the incredible climate variability that we've had recently in Australian droughts or floods or Russian heat waves, and the big swings on the supply side related to climate relative to a much tighter demand, I think, is an interesting thing to look at. But let me turn it, there's another question, Dan, you had, or Nikki? Okay.
I was curious, in the slide about the Economist and IFPRI's different rankings, the only glaring discrepancy there was in credit. And I was wondering why the discrepancy, and what do you both see as the role of credit in managing volatility?
Good question, and I don't know the answer to why credit was ranked so differently. I'm sorry.
But what do you think the productivity of credit is?
I think it's probably pretty darn high. We were talking at lunch about what turns out in Zambia and Kenya anyway, what turns out to be the critical constraint to adoption of productivity-enhancing farm technologies is credit. We tested for price instability. We thought that maize price volatility may be a factor. Doesn't seem to be coming out that way according to the household survey data, but credit was. So I think it's probably an important one.
Peter? Okay, other questions?
Yeah, I think one of the things that is sort of a difference between your views is related to the fact that, you know, Thom's working in Africa, Peter in Asia, and there's sort of a different level of governance capacity in those two regions. And I imagine, Peter, that, you know, 30, 40 years ago, maybe Asia's governance capacity was not that great either. So, you know, are there any lessons from your experience for how to build that governance capacity in Africa so that, you know, if there are these policies that we'd like to implement but don't think governments are capable of, you know, how could we get to that place?
I remember right through the 1980s when we were doing structural adjustment in Africa, and there was, you know, there was a lot of searching. Well, what's Asia doing that's getting through the global downturn in commodity prices? They're still growing. Africa's in trouble. And we used to host missions in Indonesia from Ghana, from Nigeria, from Ivory Coast, Kenya, Tanzania. I mean, you know, they'd talk about the problems that they were facing, and we'd suggest, well, gosh, you know, here's how we do it in Indonesia. And there was just that, well, we can't do that. And how do you build that capacity? You send Thom to Lusaka and you train a whole generation of people. You go to Michigan State and then you'll start training. This is intergenerational. The Agricultural Development Council spent 40 years in Asia training agricultural economists, one of whom became president of Taiwan, one of whom became the coordinating minister of the economy in Indonesia. Most of them knew each other. They were a network, and they were plugged into research systems and universities. And to be quite honest, those were folks who really used evidence-based information in putting it into a policy context. Why did Asian policy makers take them more seriously than African policymakers take the equivalent trained folks in Africa? Gosh, I guess I'd either be famous or rich if I knew the answer to that question, but I don't know the answer to that question. I do not understand the different political dynamics that we've seen. It's not democracy. That's clearly not the explanatory variable. That's not what is doing it. There's something else.
Mm-hmm. It's a great question. I don't know the answer either.
Well, it's actually a really good question to end on for a couple of reasons. One, the whole purpose of this symposium is actually to reach, you know, for future policymakers in places like sub-Saharan Africa and South Asia who are being trained in these ways. And so you're really tying into the purpose of the symposium, but also to thank our speakers. These are two people who have dedicated their entire careers to this sort of hands-on training with people who do play a really important role in these countries in working on food security issues. And so I wanted to thank you for the dedication of your careers, but also for the evening. And we do have a reception, so please join us for that and join me in thanking the speakers.